They said it like it was normal, like it was just another headline. Another day in markets, another tariff threat, another tough-sounding line meant to fire up a crowd. But what happened next is the kind of thing that usually shows up during a war or a financial meltdown. $62 billion. That's the amount of money that moved out of the United States and into Canada in 1 year. Not slowed down, not rebalanced, not rotated. Fled. And here's the part that should stop you in your tracks. In the year before, 2024, the flow was the opposite. Canada was sending money into the US like it always does, because for decades the US-Canada relationship has been built on one word: predictability. Then 2025 hits, and the whole structure flips. Instead of $50 billion flowing south, we get $62 billion flowing north. That's not a small change. That's a violent turn. A swing of more than $100 billion in 1 year. The kind of swing you see when something is breaking. So what happened? On the surface, the story looked like classic Trump energy. Tariffs, threats, reciprocal policies, and public pressure. He goes on a big stage, looks straight at the global business world, and says something that sounds like a warning and a dare at the same time. He calls Canada tough to deal with. He repeats tariff threats. He paints Canada like they're taking advantage of America. Then he goes further. He says, basically, if Canada doesn't do what we want, we don't need them anyway. No cars, no lumber, no oil, no gas. We don't need anything from Canada. That line sounds bold, until you realize what it actually signals to investors. Because investors don't hear that and think, strong leadership. Investors hear that and think, okay, so the rules can change overnight. And once the market believes the rules can change overnight, money moves faster than politics can talk. But the real shock wasn't the talk. The real shock was the tool that got used. Because in early 2025, the US government pulled out a legal weapon that was never meant for a trade fight with a friendly neighbor. It invoked the International Emergency Economic Powers Act, the IEEPA. And if that name sounds like something you've never heard of, that's because it's normally reserved for a very specific category of people and countries. Not allies, not neighbors, not Canada. This law was created in 1977 as a way for presidents to act during national security emergencies. Historically, it's been used to freeze assets and punish real threats. Iran during the hostage crisis. Iraq before the Gulf War, terror financing after 9/11s. This law is the kind of legal button you push when you're dealing with hostile actors in serious danger. And then in 2025, it gets used in disputes involving dairy quotas and softwood lumber. Let that sink in. The same legal power used to attack terror networks gets used in a fight over cheese and timber. Whether you love Trump or hate him, the market saw that and understood one message loud and clear. If the US is willing to treat Canada like an emergency, it can treat anyone like an emergency. And now the question becomes terrifyingly simple. If the rules can be rewritten using emergency powers without normal negotiations, without the usual legal stability, then what exactly are companies investing in when they build factories, buy property, or acquire businesses in the United States? Because that's not a short-term question. That's a 10-year question, a 20-year question. A factory isn't a meme stock. A supply chain isn't a day trade. A billion-dollar plant doesn't get built based on vibes. It gets built based on one thing above all: trust that the rulebook will still exist tomorrow. That's why economists talk about what some call the uncertainty tax. You don't have to raise a real tax to scare off investment. You just have to make the future feel unstable. And that's exactly what happened here. Executives stopped asking, what will the return be? They started asking, will this even be legal next month? That's not theory. That's the kind of question that kills expansion plans in boardrooms instantly. And normally when the world gets tense, money runs toward the US dollar. That's been the pattern for generations. When things get scary, the dollar becomes the safe place. People call it flight to quality. But in this situation, something weird happened. The dollar weakened, and gold exploded, pushing beyond $5,000 an ounce. That's not just inflation fear. That's deeper. Gold is what people buy when they don't trust institutions. It's the old school, I don't believe you anymore asset. When gold spikes like that, it's not just about prices, it's about confidence. So step back and look at the picture. During a crisis moment, global money didn't run toward America, it ran away from it. And that's where the story gets even darker, because the $62 billion number isn't just money in the casual sense. This isn't gamblers chasing a quick win. A huge part of this is what economists call patient capital, the kind used to build long-term projects, factories, jobs, infrastructure, acquisitions, productivity investments. That kind of money is slow to move until trust breaks. Then it becomes brutally fast, and the numbers show that break clearly. Canadian direct investment into the US collapsed, falling from around $46 billion down to about $14 billion in just the first 3 quarters of 2025. That's not a dip, that's a cliff, and it's on track to become the worst level since 2009, the global financial crisis era. But the scariest detail is this: It wasn't only that new investment slowed, it became net divestment. That means Canadians weren't just refusing to buy new US assets, they were selling the US assets they already owned. That's what people do when they stop believing in the story. And once that starts, the damage isn't just financial. It becomes structural. Because even if tariffs disappear tomorrow, broken trust doesn't vanish with the ink of a signature. And that's the hook for what comes next. Because the real fight isn't only about trade, it's about the hidden costs hitting ordinary families, the supply chains built over decades, and the quiet Canadian pivot that may be turning the entire relationship upside down. So here's the question for you before we go deeper. If money is quietly leaving America, not because of a crash, but because of unpredictability, what happens next when the next political shock hits? The hidden bill. Nobody wants to admit tariffs are sold like a weapon. Politicians talk about them like they're a punishment for the other country, like you slap a tariff on Canada and Canada pays the price. That's how it's marketed. But here's the truth that never sounds good in a speech. Tariffs are mostly a tax on your own people. Not because foreign countries are innocent, not because trade is perfect, but because that's how the math works in real life. When you tariff Canadian aluminum, who uses aluminum? American businesses, American factories, American construction projects, American car makers, American beverage companies making cans. So when aluminum costs more, they don't just shrug and say, oh well, they push that cost down the chain until it lands exactly where it always lands, on your wallet. That's why economists kept saying the tariffs in 2025 worked out to around $1,000 per American household. And you might not see it as one big charge. It shows up as higher grocery prices, higher car prices, higher repair costs, higher building materials, higher utility bills. It's death by 1,000 receipts. And it gets worse because it triggers a second problem. When inflation stays high, the Federal Reserve tries to crush it by keeping rates higher. But high rates can slow the economy, cut hiring, and drag growth. So now the country is stuck in a loop. Trade unpredictability raises costs, costs feed inflation, inflation forces higher rates threaten recession, recession fear kills investment, and while cable news argues about winning, the business world is just trying to survive the uncertainty. Now add the next layer, tourism. Canadian tourism to the US collapsed by about a third in 2025. That sounds like a random statistic until you picture what that actually means. Border towns, hotels, restaurants, shopping outlets, sports trips, family travel. This isn't only money, it's whole local economies that rely on predictable flows of people crossing the border. And when that dries up, nobody in Washington feels it immediately, but the communities feel it instantly. Now let's talk about the engine of North America, cars. People still talk like there are American cars and Canadian cars. In reality, that world mostly died a long time ago. We make North American cars. A single vehicle component can cross the border 6 or 7 times before the final car is assembled. Steel might start in Canada, then it gets shaped in Michigan, then it gets assembled in Ontario, then it gets final parts in Ohio. That's not chaos, that's decades of optimization. Each step happens where it's cheapest and most efficient. So when you throw tariffs into this system, you're not hurting Canada, you're clogging your own machine. It's like squeezing your own arteries and hoping your heart gets stronger. Instead, production slows, costs rise, supply lines break. Modern manufacturing runs on just-in-time. That means factories don't store mountains of spare parts. They rely on parts arriving on schedule. But when the government starts changing trade rules every few weeks, just-in-time becomes just-in-trouble. Factories can't plan. Managers can't forecast. Executives can't promise stable output. So they do the only rational thing. They cut shifts. They pause expansion. They move plans elsewhere. And then there's energy, one of the biggest unspoken parts of the relationship. The US imports large quantities of Canadian oil, natural gas, and power. That integration is not weakness, it's stability. It protects American consumers from shocks in other regions. It gives industries a reliable input. When you threaten that flow, you're importing volatility. It's like choosing a shaky ladder because you're mad at the sturdy one. Now here's where the story flips. While the US was focused on pressure and barriers, Canada didn't just sit there and complain. Canada started pivoting, quietly, strategically, and with a plan. A big part of their plan was building a more independent economic base, less tied to a neighbor that can change the rules overnight. They launched an infrastructure strategy and talked openly about attracting massive private investment, paired with procurement policies designed to strengthen domestic industry. And here's the weird twist. In a world full of drama, Canada's boring governance started looking valuable. Because money doesn't love excitement. Money loves predictability. It wants to know that a contract signed today still means something tomorrow. So while Washington swings between threats and pauses, Canada is trying to look like the adult in the room. Stable rules, stable legal frameworks, stable expectations. And that's why analysts started calling Canada a kind of stability trade. Not because Canada is perfect, but because in 2026, stability itself becomes a product that investors will pay a premium for. They began looking at Canadian sectors tied to real demand: energy, healthcare, infrastructure, rail transportation, long-term innovation, like quantum. These aren't hype sectors. They're not built on trend cycles. They're built on people still need this no matter who's in office. And then you get a confidence loop. Outside money flows in because Canada looks stable, markets gain liquidity, analysts pay attention, confidence rises, more capital flows in. It becomes self-reinforcing. But don't get too comfortable, because the story is not a simple Canada good, US bad fairy tale. Because while long-term investment is leaving the US, Canadians are still pouring money into American securities like crazy. So are they running away, or are they still addicted to the US financial machine? That contradiction is where things get real. Before we move on, if you had to pick today, would you rather invest where the rules are steady, or where the returns are bigger but politics is louder? The big contradiction: fleeing while buying more. Here's where the story messes with your head. We just walked through how capital is leaving the United States. We saw the collapse in direct investment. We saw net selling. We saw a trust problem. So you'd think Canadians would be pulling out across the board, right? Wrong. Even while Canadians were nervous about US policy, they still sent huge amounts of money into US securities. At one point, Canadian investors poured another $23 billion south in a single month. And since early 2025, Canadians accumulated about $124 billion in American securities. So what's going on? How can money be fleeing while also flooding in? The answer is in the type of money. There are two different rivers here. Foreign direct investment (FDI) is long-term trust. It builds factories, buys companies, creates jobs, commits for decades. Portfolio investment is often short-term return seeking. It buys stocks and bonds. It follows yield. It can reverse quickly. So what we're seeing is a split personality in the market. The patient capital is backing away because it doesn't trust the rules. The yield capital keeps flowing because the returns still look tempting. That's why most of the Canadian money going into the US wasn't even chasing stocks. Over 2/3 went into debt instruments, bonds. Why? Because US yields were higher than Canadian government bond yields, especially as the Bank of Canada eased while the Federal Reserve stayed tougher. So Canadians kept buying US debt because it paid more. And on the stock side, the pull was still the same old story. Big US tech companies. Even when people complain about the US, the global market still treats US megatech like gravity. Innovation concentration, global dominance, brand power, money still gets pulled in. But here's the irony: Canadian equities actually delivered better returns for Canadians during the same period once currency moves were accounted for. Roughly speaking, Canada returned around 25% versus 13% for US holdings after the US dollar weakened against the Canadian dollar. So Canadians would have done better staying home. But they didn't. Why? Because markets aren't purely logical. They're also behavioral. People chase what they know. They chase what's famous. They chase what's liquid. And the US market is the loudest, biggest casino in the world. Even when people don't fully trust it, they still can't stop playing. Meanwhile, Canada had its own problem brewing. Historically, foreign buyers absorbed a big chunk of Canadian government debt issuance. But as non-resident investors stepped back, domestic Canadian investors had to absorb a massive amount of Canadian debt, around $100 billion in just the first half of 2025. That's heavy. If foreign investors keep pulling away, Canada can face its own stress test. So no, this is not a clean hero-villain story. It's a complicated trade between stability, returns, trust, and dependence. But now zoom out further, beyond Canada, beyond the US, because this isn't only a North American story. This is a reserve currency story. This is about the US dollar. The US dollar isn't the world's reserve currency because it's nice. It's the reserve currency because the world believes the US offers deep markets, high liquidity, strong property rights, predictable rules. It's a trust system, and trust can erode slowly until suddenly it doesn't feel slow anymore. That's why the rush into gold above $5,000 wasn't just a random trend. Gold is the asset people buy when they don't want to bet on institutions. So if major players, central banks, sovereign funds, big institutions, start seeing the US as a place where market access can change based on politics, they won't dump the dollar overnight. That would hurt everyone. But they can do something quieter. They can stop accumulating it as aggressively. They can diversify slowly. More euros, more yen, more yuan, more gold, more other stores of value. And here's why that matters. If global demand for US Treasury debt softens even a little, yields have to rise to attract buyers. And when yields rise, the cost of financing America's huge deficits rises. That's when you don't get a dramatic collapse. You get something more subtle, and sometimes more dangerous: a credibility squeeze. A quiet margin call on the country's reputation. That's how big powers lose ground in history sometimes, not with explosions but with spreadsheets. Now, in the middle of all this, the relationship between Canada and the US is facing an uncomfortable question. Is this a temporary crisis or a structural decoupling? Experts usually frame three paths. 1. Resolution. Tensions cool, tariffs go away, relations normalize. Easy to do on paper, hard to fix trust. Because even if tariffs disappear tomorrow, companies that already moved supply chains won't rush back. Once you relocate, you don't casually reverse it. 2. Manage separation. Trade continues but deep integration slowly unwinds. Supply chains split, investment fades, dependence shrinks. 3. Accelerated decoupling. More volatility, more retaliation, more barriers. The North American model built since the NAFTA era fragments. And here's the key line. Tariffs can be undone with a pen, but trust can't be rebuilt with a press conference. The payoff. This isn't politics. It's a risk score. When people hear $62 billion fled the US for Canada, they instantly turn it into a political fight. One side says this is what happens when you stand up for yourself. The other side says this is what happens when you destabilize everything. But markets don't work like political fan bases. Markets aren't loyal. Markets don't clap. Markets don't care about your slogans. Markets run one calculation over and over. Risk versus reward. And the big point of this entire story is simple. The market is not making a political statement. It's making a risk statement. This is what happens when investors start feeling like the rules are shifting from law to mood. Because the biggest asset a country can have isn't only its GDP, or its military, or its resources. It's the belief that contracts and rules will be honored consistently. That belief is what turns a place into a safe investment. And in 2025, the US signaled fairly or unfairly that trade rules could be rewritten quickly, even by using emergency-style powers. To investors, that doesn't feel like strength. It feels like unpredictability. So money starts moving. Not all at once, not dramatically like a bank run, but steadily enough that the numbers become impossible to ignore. You saw it in direct investment collapsing. You saw it in the shift toward net divestment. You saw it in the fear-driven demand for gold. You saw it in the weakness of the dollar during a moment when it normally strengthens. And you saw it in the real-world ripples. Higher prices disrupted manufacturing, tourism declines, supply chain stress, planning paralysis. Now add the final twist. Politics is reacting, but slowly. There are signs parts of the US political system are starting to feel the economic pain, like bipartisan pushes to overturn certain tariff rounds. That matters because it suggests the costs are now hitting constituencies hard enough that even a polarized system can't ignore it forever. But here's the problem. Even if Washington suddenly turns calm and predictable, companies are already changing behavior. And once corporate behavior shifts, it tends to stick. If you moved your supply chain because of risk, you don't rush back just because the tone improved. You wait, you watch, you build redundancy, you diversify again. This is why the transcript's most important idea is trust. The US-Canada relationship wasn't just about trade volume. It was about deep integration, built since the NAFTA era, where both sides could plan long-term around stable rules. If that stability is seen as broken, the model changes. And when the model changes, the winners and losers aren't only politicians. It's workers, it's border economies, it's manufacturers, it's families paying higher prices, it's investors trying to protect savings, and it's Canada trying to protect itself too, because remember, Canada isn't immune. Canada has its own challenges. Heavy debt absorption domestically, foreign investors stepping back, the need for fiscal discipline, pressure to keep credibility intact. So Canada's strategy isn't a victory lap, it's a defensive move, a pivot, a rebalancing away from overdependence on one partner. And here's the payoff. The reason money is flowing north isn't because Canada suddenly became a magical paradise. It's because in a chaotic world, steady becomes valuable. In 2026, stability is not boring. Stability is rare. And when something becomes rare, the market pays for it. That's why Canada's boring sectors suddenly look attractive. Energy that keeps cash flowing, infrastructure spending with real assets, healthcare under stable regulation, transportation and rail tied to real demand, innovation pockets that aren't priced like hype. It's not that Canada is perfect. It's that compared to a world where rules swing hard, Canada looks like a place where contracts will still mean something tomorrow. Now here's the real takeaway you can use. If you want to understand where money moves, don't just watch headlines. Watch predictability. Ask, can rules change overnight? Are treaties treated like commitments or like suggestions? Is policy made through stable processes or emergency shortcuts? Are businesses able to plan 5 years ahead? Because capital is long-term by nature. When long-term capital starts pulling back, it's a signal that goes deeper than market mood. It's a signal about institutional trust. And if you're wondering where this goes next, watch one thing. Not what leaders say. What companies do. If factories keep getting announced in stable jurisdictions, if supply chains keep relocating, if M&A stays weak, if direct investment keeps falling, then you're not watching a temporary storm. You're watching a structural change. And that's why this story matters beyond Canada and the US, because it hints at something even bigger, a world where the US is no longer automatically treated as the default safe place. Not because it collapses overnight, but because trust gets slowly shaved down until the world starts hedging more aggressively. That's when gold rises. That's when reserve diversification grows. That's when borrowing costs climb. That's when power shifts, not loudly but permanently. So here's my final question to you. Do you think this is a temporary shock that gets patched, or the first chapter of a new North America where the old integration model never fully returns? If you made it this far, drop a comment with your view, because the next step in this story will be decided by real choices being made right now. And if you want more calm, fact-based breakdowns like this, where we cut through the noise and look at what the money is actually doing, subscribe, because the next few months are going to reveal whether this was a warning or the beginning of a long split.